In this short tutorial, we'll examine how to make financial decisions that relate to adding or deleting a product line. In this example, we must consider two categories of cost. Avoidable costs are costs that will not continue if an ongoing operation is changed or deleted. Unavoidable costs are costs that continue even if an operation is halted. A decision to add or drop should be based only on the avoidable revenues and costs. Revenue and cost items unaffected by the decision are irrelevant. Here's an example of how to decide whether or not to drop a segment. A company is considering dropping its food segment. The current contribution, sales less variable costs, from the segment is $300,000. Dropping the segment will yield the following fixed cost savings. Salary of the division manager, $90,000. Direct advertising, $100,000. Rent for factory space, $70,000. Should the company dispose of its food segment? To solve this problem, we must consider the avoidable effects of dropping the segment. The total fixed costs of $260,000 is avoided if the company drops the segment. The contribution of $300,000 is also lost or avoided. Thus, the company makes a net loss of $40,000 if it drops the segment. Therefore, the company should not drop its food segment as the fixed cost saving does not exceed the contribution lost. Here's another example of how to make a decision whether or not to drop a segment. Consider a discount department store that has three major departments or segments: groceries, merchandise, and media. This company has three business segments: groceries, merchandise, and media. Merchandise and media are profitable, but groceries show an operating loss of $10,000. The overall company now shows a profit of $35,000. Here, assume that the only alternatives to be considered are dropping or continuing the grocery department, which shows a loss of $10,000. Assume further that the total assets invested would be unaffected by the decision. Also assume the vacated space would be idle and the unavoidable costs would continue. Hence, after dropping the grocery segment, the company still incurs the unavoidable fixed expense cost of $60,000. Now the discontinued groceries segment shows a net operating loss of $60,000. The overall company now shows a loss of $15,000. Groceries had been making a contribution of $200,000 toward the avoidable fixed costs of $150,000. Hence, groceries was making a contribution to fixed costs of $50,000. Dropping groceries would result in a reduction in operating income from a profit of $35,000 to a loss of $15,000. Hence, the correct decision is not to drop groceries. In this short tutorial, we examined how to make financial decisions that relate to adding or deleting a product line or segment.